Julian Emanuel is Chief Equity Derivatives and Quantitative Strategist at Evercore. He joins us here on set. Julian, great to have you with us. So we've got this sort of markets, great earnings picture, et cetera, but we've got the yield today at 4.72% on the 10-year. So can stocks go higher in the face of higher yields?
So if you look at this bull market, basically the times that it's been disrupted have either been sort of AI jitters or macro concerns. And frankly, we just got through an AI jitter period that ended in July. The hyperscalers' earnings price reactions showed us that we've gone past it. And frankly, when you think about all the financing and the deals that have been announced the last few days, you see that the AI revolution is very much alive and well, but it's dependent on capital markets. And the issue, as we've seen several times, is when yields get to a level where they're providing more competition for corporate debt, and it appears to be approaching that level, that causes the markets to hesitate. And we think that that's a period that we're approaching.
I mean, but as we sit here at 4.733% on the 10-year yield, Julian, we hear about this deal for NVIDIA's customers through this consortium of banks and people who will look for capital basically on the behalf of NVIDIA customers. Do you think that maybe this whole AI build-out's a little bit vulnerable? I mean, the fact that these customers will get preferential yields on loans made to buy NVIDIA infrastructure, I don't know, does the whole thing seem a little fragile or does it seem stronger?
Well, I wouldn't describe it as fragile. What it is we're living through an age where the creativity around financial markets is very, very intense. And who would have thought of the deal that got announced yesterday until we saw it on CNBC yesterday afternoon? That's the kind of innovation that keeps capital markets moving forward. But again, you get to a point when you think about the transmission mechanism of oil into yields where it becomes a macro headwind for stocks approaching September, which tends to be a little bit more difficult, and approaching the midterms, which if you look at the last two midterm elections, we've had a lot of fall volatility.
Do you look at the announcement yesterday, and now I'm talking about the AI announcement, as more than, I mean, there's sort of two views of it. One is that it is a full-on commitment. Another view is this is an MOU that is no different than what NVIDIA did with OpenAI 6 months or a year ago now.
Well, I think 2026 will be the dichotomy between full-on commitments and MOUs, both politically and technologically and et cetera. What it shows is this commitment in the bigger picture to continue to facilitate the AI build-out with the expectation that productivity is going to show the boost that we believe it will in the coming years. And frankly, again, if you think about the demographic headwinds and you think about where things are moving, it makes a lot of sense to us.
But you think a yield above 4.8% is going to be difficult for the markets?
If you look at the history of this, it's almost 4 years since ChatGPT was announced to the world. You've risen above 480, and that essentially has stopped markets in its tracks. And I go back to last year and remember the political discourse around the tariff tantrum was sensitivity around the 10-year yield. We seem to have taken our eye off that ball a little bit.
Yeah, the 2-year yield is at 4.255. Do you think if we get sort of indications the Fed is going to hike in September and the odds with yields are going higher as we approach that meeting at this point, it's like 50-something% that they're going to hike in September. Is that going to be a good signal for the market? Will that be enough for the markets to sort of move on the belief that the Fed is identifying inflation as a worry?
Well, so first off, we're not entirely certain that we're going to get that much heads up. If you think about how Warsh has conducted the last couple of months, it may feel like it's going to be a coin flip into that September 16th meeting. But in general, I think the market would rather see the intent to hike because, in fact, it has a chance to dampen longer-term yields because you keep inflation expectations anchored.
You have a target of 9,000 on the S&P 500 by the end of next year. Is that right?
Well,
End of 27.
End of 27.
What we've said, and we've said this at the beginning of the year, 7750 is the base case, but under the right circumstances, and the right circumstances being, extreme capital markets activity, FOMO like we've seen at the peak of every structural technology-driven bull market, that you could move as high as 9,000. And what we didn't expect, we thought 9,000 at the beginning of this year looked more like a bubble. But guess what? Earnings have surprised everyone to the upside. And so, frankly, 9,000 is no longer even a bubble type thought. We think you can get there before the cycle ends.